Investing money in the right avenues for wealth creation holds significant importance. One such avenue is the stock market, which offers lucrative opportunities for investors to generate high returns over time. However, in order to achieve such returns, it is crucial to comprehend the functioning of the equity market. Hello everyone, welcome back to our channel Study with Focus, and in today's video, we are going to learn about the basics of stock market and how does it works. Participants of the stock market. The stock market serves as a platform where investors engage in trading shares, bonds, and derivatives, with stock exchanges facilitating this process by connecting buyers and sellers. In the Indian stock market, four key participants play crucial roles. 1. Securities Exchange Board of India, SEBI. SEBI functions as the regulatory body overseeing the stock markets in India. Its primary objectives are to ensure efficient and transparent operations of securities markets and safeguard the interests of all participants. SEBI establishes regulatory frameworks that exchanges, companies, brokerages, and other participants must adhere to, aiming to protect the interests of investors. 2. Stock exchanges. Stock exchanges play a vital role in facilitating the trading of shares, bonds, and derivatives within the stock market. In India, there are two primary stock exchanges, namely the Bombay Stock Exchange, BSE, and the National Stock Exchange, NSE. These exchanges provide a centralized marketplace where buyers and sellers can come together to execute their trades. 3. Stockbrokers and brokerages. Stockbrokers and brokerages act as intermediaries between investors and the stock market. They execute buy and sell orders on behalf of investors in exchange for a fee or commission. These professionals and firms provide essential services such as market research, investment advice, and trade execution, enabling investors to participate effectively in the stock market. 4. Investors and traders. Investors are individuals or entities who purchase shares of a company's stock with the intention of becoming partial owners and profiting from the company's growth and success. They hold these shares for the long term, focusing on factors like the company's fundamentals, growth prospects, and dividend potential. Traders, on the other hand, engage in more frequent buying and selling of stocks, aiming to profit from short-term price fluctuations. They employ various trading strategies and techniques, including technical analysis and market timing, to take advantage of market movements. Both investors and traders contribute to the liquidity and overall functioning of the stock market, albeit with different approaches and time horizons. Markets. To understand how the share market works, the next thing is to learn about primary and secondary markets. 1. Primary markets. The primary stock market serves as a platform for companies to raise capital by issuing stocks to meet their investment requirements and fulfill liabilities. Companies list their shares in the primary market through an initial public offering, IPO. During an IPO, the company sells its shares to the public for the first time. The IPO remains open for a specific period, during which investors can bid for shares at the announced issue price. Once the subscription period concludes, the shares are allotted to the bidders. This process transforms the companies into public entities as they have distributed their shares to the general public. Companies listing on the primary market pay fees to the stock exchanges and provide essential financial information, including quarterly/annual reports, balance sheets, income statements, and information about new projects or future objectives, to the stock markets. 2. Secondary market. After a company's shares are initially offered to the public in the primary market, the next step involves listing the company on the stock market. This listing enables the freely buying and selling of the company's stock in the secondary market. The secondary stock market is where shares of a company are traded among investors once they have been issued in the primary market. In the secondary market, investors can buy and sell shares based on prevailing market prices, allowing for liquidity and continuous trading activity. See trading in the stock market. After a company's stocks are listed on the stock exchanges, they can be traded in the secondary market. The buying and selling of these stocks in the secondary market are carried out by stockbrokers or brokerage firms, acting as intermediaries between investors and the stock exchange. When you place a buy order for shares, your broker relays the order to the stock exchange. The stock exchange then searches for a corresponding sell order for the same share. Once a buyer and seller are matched, a price is agreed upon to finalize the transaction. The stock exchange notifies your broker that your order has been confirmed. Your broker relays this confirmation message to you in real time, typically within seconds. Simultaneously, the stock exchange verifies the details of the buyers and sellers involved to ensure a smooth transaction without any defaults. It facilitates the actual transfer of ownership of shares from the sellers to the buyers, a process known as the settlement cycle. In the past, stock trades used to take several weeks to settle. However, the settlement cycle has now been shortened to T+2 days, meaning that the settlement is completed within 2 business days from the transaction date. This improvement in settlement time ensures faster and more efficient trading in the stock market. For instance, if you buy a stock today, the credit for the transaction is typically given by the end of the day. This ensures promptness in the stock market. The stock exchange plays a crucial role in ensuring that trades of stocks are honored during the settlement process. If the settlement cycle extends beyond T+2 days, it undermines the integrity of the stock market as it implies that trades may not be upheld as intended. Stockbrokers assign a unique code to each investor to identify their clients. Once a transaction is completed by an investor, the stockbroker issues a contract note, which provides comprehensive details of the transaction, including the time and date of the stock trade. In addition to the purchase price of a stock, investors are also responsible for paying brokerage fees, stamp duty, and securities transaction tax. These costs are deducted from the sale proceeds in the case of a sale transaction, with the remaining amount paid to the investor. Within the communication chain at the broker and stock exchange levels, multiple entities and parties are involved. This includes the brokerage order department and exchange floor traders, who contribute to the smooth flow of information and execution of trades. That's all for today. Hope you learned something new. See you in next video.